Welcome to Vold Revolution channel. Today we present a summary of the book Efficiently Inefficient by Lasse Heje Pedersen. Efficiently Inefficient. How smart money invests and market prices are determined is a comprehensive guide to strategies used by hedge funds. It covers both equity and fixed income and explains such diverse approaches as quantitative, macro, dedicated short bias, and many more. The author is Lasse Heje Pedersen, who is a professor at Copenhagen Business School and the New York University Stern School of Business and a principal at AQR Management. As an illustration of the thoroughness exhibited by the author, the section on statistical arbitrage details techniques involving dual-listed shares, multiple share classes, pairs trading, reversal strategies, index arbitrage, and closed-end fund arbitrage. Let's find out more. That is quite the syllabus, and it really sets the stage for our deep dive today. Our mission is to take this incredibly comprehensive guide, which connects the ivory tower of academia with the high-stakes world of hedge funds, and really extract the core operating manual for smart money. We want to understand the central premise. How can markets be both efficient enough to make easy profits impossible, yet inefficient enough to reward true skill and risk-taking?
It's a synthesis, really. We're looking at how these proprietary trading strategies of, global macro titans like George Soros and quant powerhouses like Cliff Asness, how they ultimately boil down to a few universal factors and a shared understanding of market frictions.
So if you want a shortcut.
Exactly. If you want a shortcut to understanding how the most successful active managers operate, this book really provides the framework.
Right. We're not just reviewing textbook finance here. We're diving into the frameworks that explain how prices are truly determined in the real world.
A world where transaction costs, margin calls, and human emotion are, frankly, as influential as dividend streams.
Okay, let's unpack this, starting with the central idea of market function itself. The efficiently inefficient paradox. For decades, classic finance theory was dominated by the efficient market hypothesis, which basically says that prices reflect all relevant information, making it impossible to consistently achieve abnormal returns, or alpha.
Right, so active management in that world is a fool's errand.
Exactly.
Yeah.
But Professor Pedersen starts the book by pointing out the ultimate logical inconsistency of that entire theory.
And the logical inconsistency is it's elegant in its simplicity. If prices truly reflected all available information, it would imply that every security is perfectly priced relative to its risk.
Yep.
So if that's the case, no one would have any incentive to expend time, money, or effort to collect information, analyze financial statements, or, search for mispricings.
Why bother? Why hire expensive analysts or run sophisticated computer models if the price is already correct?
Precisely. And if no one bothers to research, analyze, or trade actively, if everyone is passive, then what happens?
The market stops being efficient.
Immediately. Prices would be based on naive, unsophisticated noise trading, and they disconnect entirely from fundamentals. And that would, ironically, make beating the market incredibly easy.
So the market has to exist in this state of tension. It can't be perfectly efficient, because that removes the reward for the very activity that creates efficiency.
Right. And
it can't be wildly inefficient, because the enormous profits available would immediately attract smart money, which would then close those gaps.
That's the balance point. That's the efficiently inefficient market. It implies that prices reflect enough information to make consistent net of cost profits extremely difficult, but not all information.
Okay.
Competition among arbitrageurs ensures that the marginal expected return from trading, after you account for all costs and risks, is driven down close to zero, or at least to its required risk-adjusted premium.
This leads to what I think is the most counterintuitive finding in the book, and it's critical for you, the thoughtful investor, to really grasp this. The book argues that returns, net of costs, are close to efficient, yet prices can deviate significantly from the fundamental value. How is that possible? How can a price be fundamentally wrong, but a manager still struggles to profit from it?
The difference really lies in the definition of profitability and the role of friction. So when an arbitrager spots a deviation, say, stock A is clearly undervalued by 10%, they buy it. But their net return from this trade depends on four things. First, that 10% mispricing eventually correcting. Second, the time it takes to correct.
Okay. Right.
Third, the transaction costs to enter and exit the trade. And fourth, and this is the big one, the risk that the mispricing gets worse before it gets better. So if the arbitrager has to put up a large amount of margin collateral to hold that position, and if the price deviation widens for 3 months before correcting, Well, the cost of funding the position and the stress of the margin calls can erode or even completely eliminate the profit.
So the net expected return, even from a clear price deviation, is often low.
It is, because the manager is compensated only for bearing the risk that the deviation widens and for covering all the associated financing costs.
So the $10 mispricing might be real, but if it costs $5 in commission and another $5 in funding costs and the risk premium for holding that volatile position, the net expected return is zero.
Exactly. The price is wrong, but the net return is fair. And this focus on real-world frictions is why the elegant models of traditional finance so often fail to describe market reality. The book details how 3 pillars of neoclassical finance they break down when you introduce frictions like transaction costs and funding constraints.
Okay, let's start with the most famous one, the irrelevance of capital structure. The Modigliani-Miller theorem.
M&M, right. In its perfect theoretical form, it states that in the absence of taxes, bankruptcy costs, and asymmetric information, the value of a firm is independent of how it's financed.
So its debt-to-equity ratio doesn't matter.
Correct, but in the real efficiently inefficient world, that's just false. Capital structure matters profoundly due to funding frictions. High debt makes a firm vulnerable to liquidity shocks and mandatory deleveraging.
Forcing it to sell assets at fire sale prices.
Precisely. And that vulnerability is priced into the equity.
Okay, then we have the capital asset pricing model, or CAPM. This is the foundational theory for calculating required returns. In CAPM, required return is proportional only to systematic market risk, or beta.
But the book shows that CAPM is severely incomplete. Required returns in a frictionless vacuum are one thing. Real-world returns are influenced by transaction costs, market liquidity risk.
The risk that a security drops in value during a system-wide crisis.
Right. And crucially, funding liquidity constraints, which is the risk of being forced to unwind due to margin calls. If you're bearing a unique liquidity risk, you demand compensation for that risk that CAPM simply doesn't measure.
And finally, the theory of two-fund separation. The idea that all investors should hold the same risky portfolio, the market portfolio, and just combine it with a risk-free asset.
That theory fails because investors are constrained. If you're an individual or an institution that can't use leverage easily, you are prevented from simply borrowing money to achieve your desired risk level with the market portfolio.
So what do you do instead?
You end up choosing a different risky portfolio altogether. You often demand higher risk lottery ticket assets in the hope of achieving higher returns, even if those assets have a lower risk-adjusted return profile.
So this variety in funding constraints means everyone holds a different portfolio.
And that destroys the concept of two-fund separation.
This sets the stage beautifully for the active manager then. Their job isn't just finding mispricings, but having the capital structure, the risk tolerance, and the low-cost execution to overcome the frictions that defeat less sophisticated investors. So despite the incredible specialization across the hedge fund world, from dedicated short sellers to macro trend followers, Professor Pedersen argues that all profitable systematic strategies rely on a handful of universal investment styles. Factors that consistently work across asset classes and markets. What are these 4 key drivers?
These are really the pillars of systematic investing: value, trend following, or momentum; low risk, which is also called betting against beta; and quality. These are the persistent drivers of return that active managers are always seeking to capture.
Let's start with the oldest concept in the book, value. What drives its persistence?
Value investing means buying cheap securities, typically defined by metrics like a low price-to-book ratio or a low price-to-earnings ratio, and then shorting the expensive ones. The strategy's persistence is driven by 2 powerful forces.
Okay.
First, there's an economic compensation for risk. Value stocks are often distressed, they're illiquid or cyclical, and so they carry a higher systematic risk premium.
And the second driver?
The second driver is behavioral, and it's the classic source of opportunity in an inefficient market: investor overreaction to bad news. When a company suffers poor performance for several quarters, investors tend to extrapolate that bad news far into the future.
Which causes the stock to become severely discounted.
Exactly, often below its true fundamental recovery value. Value managers exploit this pessimism, knowing that the overreaction will eventually mean revert.
So it's a bet on rationality eventually winning out against market pessimism. Now, let's pivot to its behavioral mirror image. Trend following, or momentum. This is often seen as the opposite of value buying winners and selling losers. Why does momentum work?
Momentum is primarily driven by an initial underreaction to positive news. When a company announces good results, investors often process the information slowly, or they might require confirmation, so the stock price initially just drifts up slowly.
And then it gets amplified.
It gets compounded by capital flows, herding behavior, and performance chasing, which accelerates the trend. And eventually, this leads to overshooting, a delayed overreaction, which is where the trend eventually peaks and reverses.
So managers just ride this wave.
They ride this multi-stage price adjustment. It's often summarized as, the trend is your friend. That's why managed futures funds and systematic momentum strategies consistently generate alpha. They're exploiting the market's psychological sluggishness.
So value exploits market overreaction, and trend following exploits market underreaction. These two styles perfectly illustrate the efficient yet inefficient nature of pricing. What about low-risk investing, sometimes called the betting against beta strategy?
This is one of the key revelations in modern finance, really. The betting against beta, BAB strategy, involves buying low-risk, safe assets, those with a low beta relative to the market, and leveraging those positions, while simultaneously shorting high-risk, high-beta assets.
And the profit comes from what?
The profit comes from what we term the leverage risk premium. Remember our discussion on two-fund separation.
Yeah, that many institutions can't use leverage.
Exactly, because many institutional investors and fund mandates prevent or heavily restrict the use of leverage. They can't just buy the market and lever up. To achieve higher returns, they're forced to overinvest in high-volatility, risky stocks, the so-called lottery ticket assets.
And that pushes the prices of those risky assets up.
Correct, which in turn lowers their expected return.
Wait, so high-risk stocks actually give you less compensation per unit of risk than theory predicts?
Exactly. The empirical security market line is flatter than predicted by CAPM. The clever money, the hedge funds, exploit this by leveraging the safer assets, and they achieve a superior Sharpe ratio than the unlevered market index. They're essentially monetizing the friction imposed by institutional leverage constraints.
That is a phenomenal insight. It links the structural constraints of the investment world directly to a persistent alpha source. Okay, finally, let's discuss quality investing.
Quality investing is, it's straightforward but powerful. It's focusing on firms with strong fundamentals, high profitability, stable earnings, strong growth, sound management, often measured by metrics like high return on equity, low debt, and high payout ratios.
And why does this work? It seems obvious that good companies should be good investments.
It does, but the key is that, once again, the market adjusts slowly to these positive characteristics. While high-quality stocks should certainly trade at a premium, the market often takes time to fully appreciate and incorporate sustained excellence into the price. This allows the disciplined quality investor to earn high returns over time as that value is slowly recognized.
And the most sophisticated managers rarely use these styles in isolation, do they? They combine them. The book highlights the combination of value and quality, which often results in the strategy known as quality at a reasonable price, or QARP.
QARP is the strategy that seeks the best of both worlds. You're buying profitable, growing, well-managed companies, but only when they're trading at a discount compared to their peers or their historical averages. It's the perfect hedge against the value trap.
The classic Warren Buffett observation applies here. Whether we're talking about stocks or stocks, I like buying quality merchandise when it is marked down.
That's it, exactly. And this synergy is crucial because it addresses the single greatest risk in pure value investing. If you only chase the lowest price-to-book ratios, you're often buying companies whose business models are decaying and whose low price correctly reflects that fact. By adding the quality filter, you avoid the cheapest, most toxic firms whose book value is just eroding rapidly due to sustained negative earnings, which turns the whole thing into a losing bet.
So QARP targets firms where the PB normalization will be driven by the price rising, not the book value falling.
Precisely.
We've established what strategies work. Now let's focus on who is using them and how they structure their business. Hedge funds are the ultimate expression of smart money, largely unconstrained by the limits of mutual funds. What defines their primary objective?
The key difference is the performance benchmark. A traditional mutual fund has a relative return benchmark. They aim to beat the S&P 500, for instance.
So if the S&P falls 30% and they only fall 25%, they've succeeded?
They've succeeded. They beat their benchmark and they look good. Hedge funds, conversely, typically pursue an absolute return benchmark. They're often aiming to beat cash or the risk-free rate. Their core objective is to deliver positive returns in any market environment.
The hedge part of the name.
That's the hedge. It requires them to actively manage market risk, so their returns are independent of broad market moves, offering true diversification to their investors.
And this absolute return goal is what justifies the high fees they charge, notoriously the 2 and 20 model. Let's break down that fee structure, focusing on the crucial safeguard for the investor, the high watermark.
Okay, so the classic structure is a 2% management fee levied on total assets under management regardless of performance. That's used to cover operations, research, salaries, and so on.
But the big money is the performance fee.
The big money is the 20% performance fee charged on profits. But the high watermark, HWM, is absolutely vital here. If the fund's net asset value, its NAV, drops, say, from $100 to $90, the manager cannot charge performance fees on any gains until the NAV has recovered beyond the previous high water mark of $100.
So they don't get paid for just getting you back to where you started.
Exactly. It ensures the manager's incentive is strongly aligned with generating new, positive, absolute returns for the client. Though it's worth noting the HWM is generally calculated per individual investor account, since people come and go at different times.
The book really stresses that high fees mean the manager has to truly generate alpha that's uncorrelated to the market.
Oh, absolutely. Otherwise, the fees alone will guarantee long-term underperformance. If a fund simply tracks the S&P 500 but charges 2 and 20, you might as well just buy a cheap index fund.
The difficulty then is discerning whether that reported performance is genuine alpha or just a mirage created by data artifacts. This brings us to the thorny issue of hedge fund data bias.
It's a huge issue. Since reporting to public databases is voluntary, the collected data is notoriously skewed.
Okay, so let's detail the two major structural biases that inflate the average historical performance we see reported.
The first is backfill bias. When a fund decides to join a database, they often volunteer their past performance data. They backfill their track record. Unsurprisingly, funds are far more likely to join after a period of exceptionally good performance.
So they hide the bad years.
They might just wait until they hit a hot streak to report, which artificially pushes up the average returns for the reported universe during those early years.
And the second one?
The second is even more pervasive. Survivorship bias. This is the effect of bad outcomes just disappearing from the index. Funds that experience poor performance, shut down, or simply decide to stop reporting just drop out of the database.
So when you calculate the average return of the index today, you're only averaging the returns of the funds that survived.
Right. If half the funds in the database failed, the average return of the remaining half will look significantly better than the true return realized by the average dollar invested in the entire universe.
And there's an additional non-quantifiable bias, isn't there? The exclusion of the very best funds.
Absolutely. The most successful, most capacity-constrained funds, the legends like Renaissance Technologies Medallion Fund, they often choose not to report to any public database. They have more capital than they need, they value secrecy for their edge, and they don't want to attract competitor analysis.
So the data we see is missing the very top performers.
Which means the universe of public hedge fund data excludes some of the most phenomenal track records, making it almost impossible to know the true average potential return of the entire smart money industry.
Given these data hurdles, how does a sophisticated investor or internal risk manager properly evaluate if a strategy is truly delivering skill? We need metrics that go beyond simple returns. The foundational tool, of course, is the Sharpe ratio.
The Sharpe ratio, SR, is the cornerstone. It measures the reward, the excess return, over the risk-free rate per unit of total volatility or standard deviation. A high Sharpe ratio suggests superior performance without taking excessive risk.
And a Sharpe above 1 is good, 1.5 is excellent.
Generally, yes. But the book notes that while the Sharpe ratio is essential, managers sometimes prioritize a different metric when evaluating strategies internally, the information ratio.
The information ratio, IR.
The IR is used when you're measuring performance relative to a specific benchmark, not just the risk-free rate. It measures the strategy's reward, the alpha it generates per unit of tracking error risk. Tracking error is the volatility of the difference between the strategy's return and the benchmark's return.
So if a manager is hired to beat the S&P 500, the IR tells you how efficiently they use their risk budget to generate that outperformance.
Precisely.
I recall the book mentioning the frustration of investors who get fantastic Sharpe ratios but modest absolute returns. They complain, you can't eat risk-adjusted returns.
Right. And that's where the alpha to margin AM ratio becomes essential for capital allocators. A strategy might have a phenomenal Sharpe ratio of 1.5 because it takes minimal volatility and generates a consistent 3% return annually. That's low risk, but it's also low absolute return.
So the AM ratio looks at capital efficiency.
Exactly. It evaluates the strategy's profitability, its alpha, relative to the required margin capital tied up in the position. If a manager can leverage that low-risk, high-Sharpe strategy internally, say leveraging it up 3 times, they can achieve a much higher absolute return while maintaining the same high risk-adjusted profile relative to the capital used.
Okay, so moving beyond internal metrics, a major external challenge, especially in over-the-counter markets, is the stale price problem. If we can't trust the daily closing price reported by a fund, how does that corrupt our performance evaluation?
Stale prices are the bane of accurate risk assessment. Imagine a fund holds a portfolio of illiquid fixed income derivatives or private equity stakes. These aren't marked every second on an exchange.
They might be marked weekly or monthly.
Right, so if a major market event happens on Tuesday, the fund's price might not reflect that until Friday or even the following week. This delay artificially depresses the reported volatility because the price changes are smoothed out. More importantly, it completely mismeasures the true market correlation, or beta.
How so?
If the market tanks on Tuesday and the fund's price tanks on Friday, a standard linear regression comparing Tuesday's market movement to Tuesday's fund movement will show zero correlation.
Suggesting the fund has near zero beta and immense alpha.
A completely false result.
So that makes the apparent alpha totally meaningless.
Yeah.
How do we adjust for that time misalignment to find the true risk profile?
We use the lagged beta methodology. Instead of simply running a regression against the current market return, we regress the fund's excess return against the current market return and the market returns from 1 day, 2 days, or even a week ago.
So you're capturing the delayed reaction.
Exactly. By summing up all those coefficients, the current beta, the lagged beta, and so on, we arrive at the true all-in beta. This captures the fund's total inherent exposure to the market, even if that exposure is realized with a time delay.
And once you have that true beta, you can calculate the real alpha.
The corrected, adjusted alpha, which accurately reflects the fund's actual skill beyond its market exposure.
That's a crucial correction. Finally, once performance is measured, there's the process of performance attribution. Why is this retrospective review so vital?
Performance attribution is the detailed breakdown of where the returns came from. Was the profit driven by the value strategy, the momentum strategy, the long book, the short book, or was it just a favorable currency fluctuation?
And this is vital for a few reasons.
3 interlocking reasons, really. First, for client reporting. Transparency is key. Second, for internal management. The firm needs to know which investment models are working and which are just noise. And third, for capital allocation. If one portfolio manager is consistently generating high-quality alpha, the firm will allocate more of its limited, valuable capital to that specific strategy. It's how smart money figures out where their edge truly lies.
If markets are efficiently inefficient, alpha isn't just lying around. It has to be systematically pursued. Let's just reiterate the 3 primary, repeatable sources of alpha that a savvy investor can exploit.
Okay, these 3 sources really correspond to the different ways the market is inefficient. First is the information edge.
Acquiring proprietary data or having superior analysis.
Right, like using satellite imagery to count cars in Walmart parking lots to predict sales. The critical distinction here is maintaining a legal edge. You have to avoid illegal insider trading.
Okay, number 2.
Risk premium compensation. This is alpha generated by bearing systematic risks that most other investors cannot or choose not to bear. This might be bearing liquidity risk offering to buy when no one else will, or bearing funding risk. You're paid a premium for offering these services to the market.
And the 3rd.
Behavioral biases and limits of arbitrage. This is about exploiting slow market reactions and structural pressures. A classic behavioral anomaly is the post-earnings announcement drift. A stock that beats earnings often continues to outperform for weeks because the market only slowly incorporates that news.
Okay, so once a manager identifies a potential signal, say a tendency for certain stocks to underperform, they must test it. This requires a rigorous backtesting process. What are the components for a valid backtest?
A backtest simulates the strategy over historical data, and to be valid, every detail has to be precisely defined. First, the universe. What's the exact scope? S&P 500 stocks. Small caps globally.
Then the signals.
Right, signals. Precisely define the input data. If the signal is PE, is it trailing or forward PE? Then you need a trading rule. How often do you rebalance? Daily, weekly, monthly? What are the position size constraints?
And the most critical component.
Time lags. This is arguably the most crucial. You have to enforce appropriate time lags to ensure that the data you're using to trigger a trade was actually available to the public at that point in time.
For instance, if you're using quarterly sales data, you can't trade on the last day of the quarter.
You have to simulate the trade only after the firm publicly filed its 10Q. Failing this step leads directly to the most destructive error.
And that destructive error is the in-sample bias. We have to emphasize why optimizing a strategy over the exact same period you tested on is, well, it's intellectual cheating.
It is cheating because you're using future information to define your optimal parameters. Imagine you're trying to find the perfect length for a momentum signal. You test 1 month, 3 month, 6 month, and 12-month lookbacks over the last 20 years, and you find that a 7-month lookback generated the highest returns.
So you report the results using the 7-month parameter.
But you've effectively looked into the future. You've selected the parameter that worked best for that specific historical data. When you run it forward into new, out-of-sample data, performance will inevitably degrade, often severely.
So a correct backtest has to separate the optimization period from the testing period.
Exactly. Or the parameters must be dynamically updated using a rolling window, ensuring that today's parameter setting only uses data available up to yesterday. This discipline is the line between academic rigor and fool's gold.
Moving into portfolio construction, we reiterate the famous adage, diversification is the only free lunch in finance. But in the world of leverage, what's the single most critical step a manager must take to prevent one bad trade from wiping out the entire fund?
The absolute necessity is establishing strict position limits. The book illustrates this with the cautionary tale of brilliant MBA students who identify a near-perfect arbitrage. They get greedy, sizing the position up to 40% or 50% of their capital.
Believing the trade can't fail?
And when the market moves against the position temporarily, as markets inevitably do, they face a devastating margin call they can't meet, leading to forced liquidation and the loss of the entire fund.
So to prevent this, sophisticated managers like James Chanos enforce rigid mandates.
Right. No single position, long or short, can exceed 5% of the fund's net asset value. If a winner grows to 6% due to price appreciation, they automatically trim it back down to 5%. This protects the fund during those inevitable temporary price moves away from fundamentals.
This really speaks to the psychology of risk, which is often harder to manage than the math. During a crisis, traders face immense pressure. What is the central maxim designed to override emotional decision-making?
The central maxim is counterintuitive but vital. Never panic, but if you're going to panic, panic first.
Panic first.
It acknowledges that in a deep, painful drawdown, the natural human tendency is denial, then paralysis, and finally emotional capitulation. If you delay action, you become the strongest weak hand.
Meaning you hold on through 90% of the loss.
Believing in the fundamentals, only to be forced by external margin requirements to liquidate at the absolute bottom. A pre-specified drawdown control plan is designed to override that denial. If the fund is down 10%, the plan might automatically mandate a 20% reduction in all leverage.
A mechanical action to minimize emotional mistakes.
And preserve capital so the manager can re-enter when conditions stabilize.
To quantify this potential for catastrophe, managers need metrics beyond standard deviation because market returns have fat tails, right?
Exactly. So we use value at risk, VAR, and expected shortfall, ES. VAR measures the maximum loss you can expect to suffer with a high confidence level, say 99% over a given time frame.
An expected shortfall.
This is the more severe and often more realistic measure, it asks. Given that the loss threshold defined by VAR has already been breached, what is the expected size of the loss? ES captures the size of the extreme tail risk, the true damage in a crash, which standard VAR often severely underestimates.
And these statistical models are supplemented by
stress tests. These are simulation exercises where the portfolio is modeled against past catastrophes like the 1998 LTCM crisis or the 2008 Lehman collapse or future hypothetical disaster scenarios.
Let's discuss the practical side of execution. A critical question is deciding the optimal trading policy. Should a large trade be split into small pieces or executed in one massive block?
The answer depends entirely on the nature of the transaction costs, specifically whether they are increasing or decreasing with the size of the order.
So increasing costs, that's market impact.
Right. This applies to liquid, exchange-traded markets. If you're trying to execute a massive order at once, you hit multiple layers of the order book, pushing the price against yourself. The optimal strategy here is to split the large trade into small, hidden pieces and execute them slowly over time.
And decreasing costs.
This applies to over-the-counter markets like bonds, where you deal directly with a dealer. The dealer has fixed costs for the deal. If you only trade a tiny amount, these fixed costs dominate. The optimal strategy here is to trade in large chunks to leverage those fixed dealer costs.
And the total cost of execution is captured by the concept of implementation shortfall.
Implementation shortfall is the difference between the return of the desired paper portfolio, the portfolio you would hold if trading were free, and the actual realized return of the portfolio you executed. It is the total drag on performance caused by the friction of transacting.
Okay, now on to financing. Leverage is the oxygen of any hedge fund strategies. How is this leverage obtained, and what role does the lender's safety net, the haircut, play?
Leverage is obtained by collateralizing assets. For stocks, this is through prime brokers. For fixed income, usually through repo. The dealer lends the fund cash based on the value of the assets the fund owns.
And the haircut is the mandatory margin requirement.
It's the percentage of the asset value that the hedge fund must fund using its own equity capital. If you buy $100 million worth of corporate bonds and the haircut is 5%, you must put up $5 million of your own capital and can borrow the remaining $95 million.
And the size of the haircut isn't arbitrary?
Not at all. It's a crucial risk management tool for the lender. The haircut is sized based on the estimated worst-case price move, often calculated using the lender's own VIR and stress tests, that could occur before the lender has time to seize and liquidate the collateral.
The interaction between these fragile financing structures and market dynamics is the perfect breeding ground for systemic risk, leading to devastating liquidity spirals.
Take us through that chain reaction.
It's a self-feeding loop of negative amplification. It starts with an initial shock. Something adverse happens.
Okay, and that causes losses.
Right. Losses and risk tightening. The fund suffers losses, triggering internal risk systems to mandate lower leverage or, worse, margin calls from the lender.
Which leads to forced selling.
Exactly. To meet the margin call, the fund is forced to sell positions. This forced selling pushes the price of that asset down further, often moving it away from its fundamental value.
And then the lenders get scared, and they respond by hiking the haircuts on that asset, forcing even more selling by that fund and by other funds holding similar assets. The cycle accelerates, and you can get a total price collapse.
This environment of desperation creates the perfect opportunity for predatory trading.
Predatory trading is the exploitation of that forced selling pressure. If a sophisticated trader realizes that a distressed hedge fund needs to liquidate a massive position in asset Z, the predator will sell short asset Z first, driving the price down.
So when the distressed fund is forced to sell,
they sell into a weakened market, the price drops further, and the predator can then cover their short position for a substantial profit.
Shifting back to the fundamental core of equity investing, the task is always valuation. What are the two primary models fundamental analysts use to estimate intrinsic value?
They typically use cash flow or accounting-based methods. The two primary models are the dividend discount model, DDM, and the residual income model, REM.
DDM seems simple enough. The value is just the present value of future dividends.
It's conceptually simple, but it relies heavily on predicting dividend growth decades out. The residual income model is often preferred because it uses accounting data. It defines intrinsic value as the current book value of the firm plus the present value of all expected future residual profits.
Yeah, which are profits earned above the required return on equity.
Exactly. It provides a more robust framework because it ties value directly to the firm's ability to generate above-cost returns.
We discussed the pitfalls of pure value investing earlier, specifically the risk of the value trap. Let's elaborate on the dangers of simply buying based on a low metric like PB.
The value trap is the investor's worst nightmare. Mistaking a stock that is cheap for a stock that is a bargain. When you buy a stock with a low price-to-book ratio, you're fundamentally betting that the ratio will normalize.
You're betting the price will rise.
But what if the normalization occurs because the firm continues to post negative earnings? The book value falls and the ratio normalizes to a higher number while the share price stagnates or falls further.
So the market's low expectations were simply accurate.
And the margin of safety you thought you had vanishes entirely. This is why value investors must always seek qualitative analysis. The quality filter to confirm the low price is due to temporary market pessimism, not permanent fundamental erosion.
This is where we return to discretionary investing, the classic long-short equity approach that relies on qualitative analysis. Lee Ainsley of Maverick Capital exemplifies this. What's his philosophy on setting a time horizon and, crucially, deciding when to exit?
Ainsley and his peers focus on a medium to long-term horizon, typically looking 2 or 3 years out, to identify significant discrepancies between their view of a company's future and the market's current consensus.
And his view on exiting a trade.
It's purely pragmatic and forward-looking. He stresses that the original cost basis is irrelevant. The decision to sell is purely opportunistic. He exits the moment he finds an even more attractive use for that capital elsewhere in the portfolio.
Hold is not an option.
That's his phrase. Even if a stock still has meaningful upside, if he finds another stock with even greater expected risk-adjusted upside, he sells the first to deploy the capital into the second.
Let's turn our attention to the managers who focus on the flip side of the market. Dedicated short bias funds. Short selling is intrinsically difficult and costly. What are the main obstacles?
The ability to short sell is constrained, and those constraints are a core reason why stocks can often remain overvalued. The obstacles are substantial. First, there are loan fees you have to pay to the owner of the shares,
Which can be really high for hard-to-borrow names.
punitive sometimes. Second, you have to post significant margin collateral, tying up valuable capital. And third, the greatest friction is recall risk.
The lender can demand the shares back at any moment.
Right. This forces the short seller to execute a costly buy-in at market price, often at the worst possible time, forcing them to cover the short at a loss just as the price has spiked.
These frictions mean that short selling capacity is limited, which creates persistent stock overvaluation. Despite their often negative portrayal, the book emphasizes that short sellers play a vital role in the market.
They are absolutely essential. They're the market's internal critics. Bernard Baruch said it perfectly. A market without bears would be like a nation without free press.
There would be no one to criticize and restrain false optimism.
Exactly. Short sellers introduce necessary skepticism, ensuring both pessimistic and optimistic views are reflected in the price. Without them, the market would just become a cheerleading session, resulting in massive bubbles.
And their role as fraud uncoverers is undisputed. James Chanos, famous for shorting Enron, is a master of this. How did he approach the Enron case? What were the key red flags?
Chanos focuses not on a single data point, but on a preponderance of evidence pointing to fundamental decay or deception. In the Enron case, 3 specific red flags stood out. 1. Low returns on capital. Despite Enron's hyped growth story, the underlying core businesses showed stubbornly low returns on invested capital. The narrative didn't match the cash generation.
2.
Insider selling. Enron executives were systematically offloading massive amounts of stock, suggesting a fundamental lack of conviction from the people who knew the truth.
And the third was the accounting.
The black box transactions. There was cryptic disclosure of numerous related party transactions involving complex partnerships that analysts just could not decipher. When analysts admitted Enron was a black box, Chanos realized they were just relying on a trust me story from management, which is a major red flag.
Interestingly, Chanos holds a controversial view on management access. He refuses to meet management. Why is that?
He argues that access is overrated and often provides a false sense of security. Because of rules like Regulation FD, management can't provide genuinely material, non-public information. They'll just relay the standard bullish story to every investor. Chanos believes a far clearer picture emerges from a rigorous analysis of the objective financial statements.
Moving to the bond market. Fixed income arbitrage is often described as a negative feedback business, relying on mean reversion. Myron Scholes was deeply involved in this world. What was his conceptual view of the fixed income arbitrager's role?
Scholes viewed fixed income arbitragers as the reinsurers for broker-dealers. The broker-dealers, the banks, are forced by market demand to hold specific inventory. These positions are risky. Arbitrageurs step in and systematically take these risks off the balance sheets of the dealers, getting paid a premium for intermediation.
A prime example of this is the on-the-run, off-the-run trade in U.S. Treasuries.
Right. On-the-run treasuries are the most recently issued, most liquid benchmark bonds. Off-the-run treasuries are older issues with the exact same cash flows and maturity, but they're less actively traded.
So in a rational market, they should trade at the same yield.
They should. But the higher liquidity of the on-the-run bond causes it to trade at a small, persistent yield premium. Arbitrageurs short the on-the-run, the expensive one, and buy the off-the-run, the cheap one, betting on convergence. This spread is a liquidity premium, and critically, it often widens significantly during liquidity crises.
Let's shift to event-driven arbitrage, specifically merger arbitrage. This is the art of betting on a deal closing.
Merger arbitrage, or risk arbitrage, is betting that an announced corporate merger will successfully close. If stock A is acquired by stock B for $100 a share, but stock A is currently trading at 98, the arbitrager buys stock A at 98 and waits for the closing, pocketing the $2 spread if the deal goes through.
And the hedge depends on the deal structure.
It does. If it's a cash deal, it's simple. If it's a fixed exchange ratio stock deal, say, stock B offers 1.5 shares for every 1 share of stock A, the arbitrager must buy stock A and simultaneously short 1.5 shares of stock B to hedge the market risk of the buyer's stock. They're only betting on the deal closing.
This brings us to the ultimate example of conviction and risk-reward asymmetry. John Paulson's greatest trade ever, the massive short on the subprime mortgage market before 2008. What was the core insight that allowed him to size that trade so aggressively?
Paulson's insight was based on a fundamental belief in an extremely asymmetrical risk-return profile. He was paying a small annual premium, maybe 1% of the notional value, to take out credit default swaps on specific tranches of the subprime market. He believed there was a very high probability that those tranches would eventually go to zero.
100% payoff.
100% payoff. The trade required a go-for-the-jugular philosophy, something he adopted from Soros. The risk was paying that 1% annual premium for a few years if the collapse took time. The reward was a 100-to-1 return profile. His conviction, based on observing accelerating defaults, allowed him to hold the trade until the securities were nearly wiped out.
Let's turn to quantitative strategies and statistical arbitrage, or stat-arb. This relies on exploiting mispricing between related securities. The example of dual-listed shares like Unilever NV and Unilever PLC is perfect.
Unilever NV, based in the Netherlands, and Unilever PLC in the UK are two shares from a single corporate entity. They share the same underlying economic cash flows, but their shares trade separately in different jurisdictions.
So they should trade at exact parity, adjusted for currency.
They should, but in reality, technical factors and local demand shocks cause them to deviate. A stat-arb trader buys the slightly cheaper share, NV, and shorts the slightly expensive share, PLC, waiting for them to converge. Competition reduces the spread, but it doesn't eliminate it. The non-zero remaining spread exists only to compensate arbitrageurs for costs and risk.
We must conclude with the most dramatic illustration of how liquidity and leverage can override fundamentals. The quant event of August 2007. In just a few days, massive quant portfolios suffered unprecedented losses, sometimes calculated as 30 standard deviations away from normal. What did that imply?
30 standard deviations is a number that implies the event should occur maybe once in the history of the universe. The implication was clear. This was not a fundamental shock. This was a statistically different phenomenon driven by market mechanics.
A systemic deleveraging.
A collective systemic deleveraging. Because most quantitative funds share similar signals, value, momentum, low risk, and similar risk management models, they were all trying to trade in the same direction at the same time. As losses mounted, funds were forced into liquidity spirals.
They all had to sell the same long stocks and buy back the same short stocks.
Exactly. They were forced to liquidate what they could sell, not what they wanted to sell. This endogenous selling pressure pushed prices violently away from fundamentals. The risk models failed because they assumed the risk factors were independent of the fund's own trading activity.
So the event confirmed Pedersen's core premise.
It did. Prices are determined not just by value, but profoundly by the trading demands and constraints of the sophisticated investors themselves. To synthesize the entire framework, the high-performance investor profits by operating precisely within this hyper-competitive, efficiently inefficient market structure. They succeed by bearing risks, funding liquidity risk, convergence risk that others can't handle, possessing a demonstrably superior information edge, or systematically exploiting persistent behavioral biases that take time to play out.
So what does this all mean?
It means that while the core process of identifying mispricing can be systematized, the greatest challenge is maintaining the psychological fortitude to stick with a sound investment process when volatility and drawdowns test your conviction. Cliff Asness, the quant master, once reflected that a 3-year period of poor performance for a high Sharpe ratio strategy can feel like a decade to an investor. The final provocative thought for you to consider is this. When you build your investment plan, whether it's based on value, momentum, or quality. How can you build the psychological infrastructure and conviction necessary to stay the course during the inevitable, soul-crushing drawdowns that feel like a lifetime, even when the underlying process remains scientifically sound?
Thank you for watching. Please like us, share, subscribe, follow up in next topic. Welcome to the Deep Dive. Our mission today is, well, it's pretty ambitious, actually. We're diving into the world of smart money, sophisticated trading strategies, and really the fundamental question of how asset prices are truly determined.
Right.
We're essentially pulling back the curtain on how hedge funds, the big institutional investors, find their edge.
Yeah. It's about moving way beyond just the headlines.
Exactly.
And to do that, we're taking a really broad, sort of integrated look at the entire landscape. Everything from traditional deep dive stock picking all the way to
the complex quant models.
the quant models, the high stakes global macro bets. We're sort of treating the financial markets like a physical system.
A physical system. How so?
Well, a system with frictions, with pressure points, and even predictable fault lines.
Okay, let's unpack this. And to start, I think we have to explicitly come back to continue efficiently inefficient.
Yeah.
Because that core idea, it really frames all of our source material. It's the whole framework.
It is. The idea is that markets reflect enough information to make beating them consistently really, really hard.
That's the efficient part.
That's the efficient part. But, and this is the key, they do not reflect all information. And they don't price the information they do have perfectly or, instantly.
And that's the inefficient part.
That's the inefficiency. Because if they were perfectly efficient, no rational person would ever bother trading actively. Prices would just stagnate.
Right, there'd be no incentive.
Exactly. The inefficiency has to be persistent enough and pervasive enough to consistently reward the active investors for all the costs, the time, the skill, and just the sheer risk they take on.
The risk of gathering information and putting on the trades.
Right. And that reward is what we call alpha, or the active return. If markets were perfectly efficient, the extreme neoclassical view, then investors would just be paying billions in fees for nothing. Or, maybe worse, nobody would get paid for gathering information.
Then prices would just become completely unmoored from reality.
Precisely. Active managers perform this crucial price discovery function, and they get compensated for absorbing all that liquidity, funding, and complexity risk. That's what keeps the market in this efficiently inefficient state.
Which brings us, I think, perfectly to part one, the architecture of equity strategies. This is where that battle, between fundamental analysis and the systematic models really plays out. It shows that constant tension between value and price. So let's start with the classics. How does a manager make a focused fundamental decision?
Okay, so discretionary equity investing. This is the classic long-short approach. It's really the image most people have of a hedge fund manager.
Right.
It's defined by stock picking, but based on deep qualitative fundamental analysis of a company's actual business.
So this isn't just running a screen for low PE stocks.
No, not at all. This is painstaking work. It's assessing the quality of the management team, really understanding the competitive landscape, projecting long-term growth, and, maybe most critically, relying on solid accounting to estimate future cash flows with any accuracy.
And within that whole framework, you really see two dominant philosophies emerge: value and quality investing.
Exactly.
So value investors, they're focused on buying cheap securities.
Yeah.
Right. Things trading at a discount, low price to book, low PE.
Yeah, they're betting on mean reversion. The assumption is that the market has either priced in way too much risk, or it's just, ignoring some kind of temporary problem.
Historically, that's been a very profitable strategy.
Extremely profitable. It's one of the key factor returns that academics have identified, the HML, or high minus low factor. And the profit comes from the market just overreacting to bad news, which creates a temporary discount, or it's just compensation for taking on the perceived risk of that business.
But, and this is a huge but, as you dig into it, you find its biggest hazard.
The value trap.
The value trap,
Yeah.
which is a really sophisticated way to lose money. You buy the stock, the PB ratio is incredibly low, it looks like a total bargain, but then it just stays cheap.
It stays cheap because the market was actually right about the company's future. And the question is, how does that actually show up in the numbers?
Right, in the accounting.
Well, the PB ratio can only go back to normal in two ways. Either the price goes up, which is what you want,
Or the book value goes down.
or the book value falls. And if the company has sustained negative earnings or has to do big asset write-downs, that book value just collapses. So you haven't bought a bargain, you've bought a failing business.
Can you give an example of how that might be masked?
Sure. A company might aggressively capitalize its R&D costs. So on paper, its initial earnings look high and its book value seems inflated. But then the R&D never actually leads to viable products.
So the cash flow turns negative.
The cash flow is negative year after year, and eventually that book value has to be written down to reflect reality. The value investor is trapped.
And that structural risk, the value trap, is really why so many sophisticated investors like Warren Buffett kind of migrated toward the quality camp.
Precisely. Quality investing is basically designed to filter out the value traps from the start.
So what are you looking for with quality?
Quality is about finding good companies.
Yeah.
These are firms that have persistent profitability, stable cash flows, really high returns on invested capital, and just well-managed balance sheets with low debt.
You're focused on durability.
Durability and competitive advantage. The best approach, really, is a combination of the two, often called quality at a reasonable price, or QARP.
Which is Buffett's whole philosophy. He has that great quote.
Whether we're talking about stocks or stocks, I like buying quality merchandise when it is marked down. It's perfect.
It really is. So the screening process isn't just what's cheap.
Yeah.
It's what is a good, durable business, and then is it cheap enough?
Exactly right. You start with the non-negotiables of quality, consistency, durability. And the reason high-quality stocks tend to outperform is, again, this idea of slow adjustment by the market.
Inefficiency.
The inefficiency. These strong characteristics should make the prices jump immediately. But if the market adjusts slowly, those stocks just continue to deliver high risk-adjusted returns over time. So combining quality and value is this fundamental attempt to capture those returns while systematically avoiding owning deteriorating businesses.
But given that these are long-term fundamental bets, the discretionary manager, they need a path, right? A way for the market to eventually admit it was wrong.
Yes, that's where the catalyst comes in.
The catalyst, the spark.
It's the spark. It's the event, a strategic shift, a successful new product, a change in management, a big asset sale that forces the market to finally recognize the stock's true underlying value.
And this requires patience.
A lot of patience. Managers like Lee Ainsley III, his average long holding period is often over a year. That long time horizon reduces the competition and gives you time to let the market catch up to the reality you've uncovered.
And for the really aggressive funds, if they can't just wait for a catalyst to appear.
They become the catalyst themselves.
Right. Activist investings.
Yeah. This is where an investor takes a really substantial stake, maybe 5 to 10% of the company, and uses that position to influence management directly.
So they're forcing the issue.
They're forcing the issue. They might demand big dividend payouts or force the sale of an underperforming division or get new people on the board of directors. Their profit comes from forcing the company to maximize shareholder value instead of letting managers just engage in, empire building.
These costly acquisitions that don't add value.
Exactly. Or hoarding cash that should be returned to shareholders. Activists basically profit by closing the gap between what management is doing and what the firm's fundamental value demands they should be doing.
Okay, so now let's flip the entire perspective. Let's go to the bear side.
Right.
Dedicated short bias managers. These guys focus almost exclusively on finding overvalued, deteriorating, or sometimes just fraudulent stocks that they think are about to fall.
And this is where market friction becomes maybe the single most important factor.
Because it's harder to be negative.
It's so much harder. The ability to express a negative view is inherently constrained compared to expressing a positive one. And that constraint, the difficulty and the cost of short selling, is why speculative bubbles and just massive overvaluation can go on for so long.
So what are those frictions specifically?
Well, the source material details 4 big ones. First, you have to find shares to borrow, to locate lendable shares, and you often have to pay a loan fee for that.
Okay.
Second, you have to post margin, which ties up your capital. Third, there's recall risk.
Where the lender just wants their share back.
They just want it back, and it forces you to close your short position, maybe at a huge loss.
And the fourth one is?
Yeah.
It's kind of the existential one for a short seller, right? Funding liquidity risk.
That's the one. That's the risk that you simply run out of money before the trade works out. If the stock unexpectedly rallies, the short seller's losses are theoretically infinite.
And you get margin calls.
You get margin calls. And if the hedge fund is highly leveraged, even a temporary price spike against their position can trigger those calls, forcing them to buy back the stock to cover the short. which ironically just pushes the price even higher.
It's a vicious cycle.
It's a vicious cycle. And that asymmetric risk profile means that shorting requires just so much more conviction and much deeper pockets than going long.
And this friction is what allows for what John Maynard Keynes so brilliantly called the Keynesian beauty contest.
It's the perfect analogy for market mania.
So break that down for us.
The analogy suggests that investors, instead of focusing on fundamental value, are just focused on what they think other future investors will pay.
So it's a second-level game.
It's a second-level game. Imagine a stock A, and let's say everyone fundamentally agrees it's worth $100. But the market has these two types of speculators, type 1 and type 2, and they each think the other guy is going to be willing to pay $140 during some irrational boom. Even though everyone knows the true value is $100, the current price can stabilize at, say, $110. Why? Because everyone thinks they can sell it to a greater fool later on.
So nobody actually believes the stock is worth 110.
No.
But everyone is willing to buy at 110 because they're anticipating that future buying pressure. And that's amplified by the fact that the pessimists, the short sellers, are sidelined by all those frictions we just talked about.
Exactly. The short sellers, they know the stock is overvalued, but they're hesitant to deploy massive capital because that spike from 100 to 110, while it's fundamentally irrational, could completely wipe them out before the price ever comes back down.
It's an asymmetry. Positive feedback loops from optimism are just easier to sustain.
Much easier than negative feedback loops from pessimism. And that's what makes the forensic work of someone like James Chanos, the famous short seller, so vital and so incredibly difficult.
Right, and his approach is all about looking for systemic warning signs.
Chanos is famous for this. He's not looking for a single smoking gun. Instead, he focuses on patterns of questionable financial behavior. He approaches a company like a forensic accountant, searching for those telltale signs of manipulation or just a deteriorating business model.
And his analysis of Enron is the classic textbook example of this method. What were the specific red flags he saw back then that pretty much everyone else was ignoring?
He identified 4 major patterns in Enron's footnotes and filings. First, there were these cryptic related party transactions, especially the ones involving the CFO, Andy Fasto, and these partnerships called Chuco and LJM.
And these were buried deep in the SEC filing.
Buried. And they allowed Enron to offload liabilities from its balance sheet while claiming these non-cash profits. Second, he saw persistently low returns on capital. That suggested the core business was just way less profitable than all the bullish talk.
Hey, what else?
Third, they were constantly using one-time gains to artificially boost their reported earnings, which masked the fact that their core operations were losing money. And finally, there was large-scale, consistent insider selling by senior executives.
The people who knew best were getting out.
The people closest to the information were quietly heading for the exits. It was that whole mosaic of issues, not just one thing, that gave him the conviction.
And he famously said that access to management is actually overrated.
Yeah, especially after regulation FD Fair Disclosure was implemented, because now management just gives the same standardized bullish presentation to every single investor. It gives a false sense of security, and they often use complexity to hide things rather than to clarify.
It's a powerful point. Chanos argues the short seller is like the market's free press.
Absolutely. The short seller is the one who absorbs the risk and the cost of generating that crucial negative information. And his observation is just stunningly consistent. Almost every major financial fraud in the last 25 years was uncovered by a whistleblower, a journalist, or a short seller.
Not by the auditors or the regulators.
Almost never by auditors, regulators, or long-only analysts. It's a key part of the efficiently inefficient market. You're basically paying smart bears to keep the long side honest.
Okay, so moving from that very tailored discretionary analysis to something completely systematic, we get to quantitative equity investing. Quant.
Right, and the quant approach is fundamentally different. The trading rules are defined explicitly, and then they're implemented systematically across thousands of stocks using advanced tools from statistics, finance, and computer science.
So the quant revolution is basically taking all the best lessons from fundamental analysis and then just trying to remove the human bias, applying it at a massive global scale.
That's a great way to put it. You're essentially teaching a computer what a good discretionary analyst does, looking for predictable, recurring anomalies in stock returns that can compensate an investor.
And the core of this is leveraging these fundamental quant factors.
The factors, yeah. And they are basically familiar concepts that have been formalized for computers. You have value, which is captured by the HML factor, that's high minus low. It systematically buys cheap stocks and shorts expensive ones.
Okay, that's familiar.
Then you have momentum. This exploits that tendency for an initial underreaction to news, which is then followed by hurting and delayed overreaction that causes prices to trend.
And then the third major factor, which is arguably the most counterintuitive one, low risk.
Yes, often formalized as betting against beta, or BA.
And this seems to just directly violate the most fundamental concept of finance theory, right? That higher risk must equal higher returns.
It does violate the theory in practice.
Yeah.
And it does so because of a major market friction, leverage aversion, and constraints.
Okay, explain that.
The theory assumes that any investor can take on unlimited leverage. But in reality, many big institutional investors, pension funds, mutual funds, they're either restricted from using leverage or they're just psychologically averse to it. So to get higher returns, they end up disproportionately demanding the risky high beta stocks, the lottery assets.
So because all these restricted investors are bidding up the price of the high beta stocks, those risky stocks actually end up having lower expected returns than they should relative to their risks.
Precisely. So the sophisticated quant fund can come in, buy the safer low beta stocks, and then just apply leverage to them to match the risk level of the high beta stocks. And in equilibrium, those low beta stocks, once they're levered up, actually deliver superior risk-adjusted returns, higher Sharpe ratios than the high beta stocks. The BAB factor is just systematically capturing this phenomenon by buying safer securities with leverage while shorting the overpriced risky ones.
So the whole opportunity only exists because of a structural behavioral bias against leverage.
It's the perfect illustration of the efficiently inefficient framework. You have a structural constraint leverage aversion that creates a persistent, systematic risk premium that can only be harvested by sophisticated investors who are willing and able to use leverage.
But even the most mathematically rigorous, systematic approaches are not immune to market dislocations, which we saw, vividly in the 2007 quant event.
Yeah, that was a huge cautionary tale for the entire industry about the limits of mathematical modeling.
With deleveraging in August 2007 was a critical shock to the whole systematic trading world, especially for those using these long-short factor models.
It was a complete disaster. In just a 4-day period, there was this major unwinding, and it caused value and momentum factors to just sell off violently. A simulated industry-neutral long-short portfolio suffered a loss of more than 30 standard deviations.
30 standard deviations. For you listening, that number should be impossible.
It's statistically unimaginable.
It means the event was so far outside the realm of normal probability, so far from what any fundamental shock should cause, that something else entirely had to be going on.
And something else it was what's called an endogenous amplification, driven by the structure of the quant industry itself.
What does that mean?
It means as prices moved against the factor models, all these leveraged quantitative strategies were forced to liquidate or deleverage their positions really fast just to meet margin calls. And this forced selling pushed the prices of the specific stocks that were common to all these strategies even further away from their fundamental values.
So Fund A's model starts to lose money, which triggers their forced selling, which drives prices down.
Which then triggers margin calls for Fund B and Fund C, forcing their liquidations.
And you get a vicious self-reinforcing circle.
Exactly. That is the definition of a liquidity spiral. The risk didn't come from some external shock like bad economic news. It came from the internal plumbing of the trading world. And the conventional risk models, which assume that portfolio returns are normally distributed and driven by independent news, they just completely failed to capture this kind of catastrophic correlated liquidity tail risk.
So the event just proved that your risk management has to account for the risk that the market itself will just seize up.
Right.
That liquidity risk is the perfect bridge, actually, as we shift gears from single stock strategies to the bigger global view.
Yeah.
Asset allocation and global macro. This is about betting on macro trends and systemic risk, not just corporate fundamentals.
And asset allocation is the foundation. We have to start by differentiating the approaches. The gold standard for minimum trading is the only truly passive allocation, which is the market portfolio.
And it's macro consistent because your weights just naturally adjust as the total value of assets in the market changes.
Right. But most investors aren't truly passive. They use target allocations like the classic 60-40 stock-bond split, which is a constant rebalanced approach.
The 60-40. It sounds simple, but you're saying it's inherently active.
It is, because it requires frequent rebalancing to maintain those target weights. And that forced trading behavior, it translates into a perpetual disciplined value trade.
How so?
When stocks do well and rise above 60% of your portfolio, you are forced to sell them. When bonds lag and fall below 40%, you're forced to buy them.
So by definition, you're selling your strong performers and buying the poor performers, which, as David Swenson from the Yale Endowment said, is supremely rational behavior, but it takes real emotional courage.
It does, especially in extreme markets where your every instinct is telling you to do the exact opposite.
And this brings us to the more sophisticated approach, the one used by large funds and institutions. Risk-based allocation or risk parity?
Risk parity. The core idea is based on the observation that over long periods, major asset classes, equities, bonds, credits, real assets, they've all delivered pretty similar Sharpe ratios.
So similar returns for the amount of volatility they take on.
Exactly. The problem with a traditional 60-40 portfolio is that while you only have 60% in stocks, equities account for over 80% of the portfolio's total risk contribution.
So if stocks sneeze, the whole portfolio gets a cold.
Precisely. Risk parity is designed to allocate capital to equalize the risk contribution from each asset class, so each one contributes equally to the portfolio's overall volatility.
But to do that, especially since bonds are so much less volatile than stocks, the risk parity investor has to use explicit leverage on the safer asset classes.
Yes, and this is the same friction we saw with the betting against beta factor. To get a target return that's comparable to an equity-heavy portfolio, risk parity has to use leverage on assets like high-quality bonds to boost their return contribution.
So they're systematically harvesting that premium created by the fact that most investors are leverage averse.
That's it. Risk parity is structurally a strategy that is only viable for the sophisticated investor who has deep pockets and the freedom to use explicit leverage.
Okay, now let's move to global macro. This is arguably the highest stakes game in the whole field. It's focused on making these big directional bets on entire markets, indices, bonds, currencies, commodities, based on sweeping views of what central banks are going to do, or policy changes, or just overarching macroeconomic themes.
They're trying to predict the direction of the tide, not just the behavior of a single boat. And these trades require enormous conviction, and they're often expressed in really liquid markets like derivatives. And many of these positions actually generate positive cash flow just by existing.
And that's where the carry trade comes in.
The carry trade.
Carry is just earning income, even if the price of the asset doesn't change, right? And the classic example is a currency carry trade.
Right. So in a currency carry trade, an investor borrows in a currency with a very low interest rate, like the Japanese yen or the Swiss franc, and then simultaneously invest that money in a currency with a high interest rate, like the Australian dollar.
And they profit from the daily interest rate difference. That's the carry.
That's the positive carry.
It sounds a bit like free money, but we know it isn't. It has that famous return profile. It goes up by the stairs and down by the elevator.
That phrase perfectly sums up the risk. The trade generates lots of small, consistent profits. The stairs up over long periods as you collect that interest differential. But it's punctuated by these episodic, massive losses. The elevator down during what are called carry trade crashes.
When do those happen?
They often happen during liquidity crises, risk aversion spikes, and suddenly the correlations across all the high-interest currencies jump to 1. Everyone rushes to unwind the trade at the same time, forcing the high carry currencies to just collapse. The compensation you get from the carry trade is essentially a premium for absorbing the risk of those sudden, sharp unwinds.
And if we're talking global macro, we have to talk about the intellectual godfather of the field, George Soros, and his concept of reflexivity.
Yes. This moves beyond that simple linear cause and effect into psychology and market structure.
So what is the theory?
Soros's theory is that financial markets are characterized by these reflexive feedback loops, which inevitably produce what he calls dynamic disequilibrium. Standard economics assumes negative feedback, a price deviates, and then it corrects back to the mean.
But Soros said that's not always how it works.
He argued that positive feedback loops are actually common. An event feeds back into market perception, which then reinforces the event itself.
So let's walk through the anatomy of a bubble using that reflexive lens.
Okay, so a bubble starts when some fundamental underlying trend in the real world and a corresponding misconception in the market's perception start to positively reinforce each other. The initial price rise confirms the misconception, which draws in more capital, more naive investors, which pushes the price even higher.
And the boom period is long and drawn out.
It's long and drawn out, and it keeps accelerating until you hit what's called the twilight period. This whole sustained mania is the self-reinforcing phase.
That's where you get that famous quote from the former Citigroup CEO Chuck Prince during the credit bubble.
As long as the music is playing, you've got to get up and dance.
Exactly.
And that quote just perfectly captured that reflexive inertia. Even if you suspect the music is about to stop, you're still incentivized to keep dancing. But the bust, once the trend finally reverses, is always short and steep.
And it's reinforced by forced liquidation.
Violently reinforced by the forced liquidation of all those highly levered, unsound positions. It turns market disillusionment into pure panic. And Soros's genius, his ability to recognize and bet on these structural dislocations, like when he shorted the British pound in '92, it was all predicated on understanding that markets don't just reflect reality, they actively participate in creating it.
Okay, shifting to managed futures, this feels like the ultimate systematic price-driven strategy.
It is. The philosophy here is to completely ignore fundamental forecasts and focus exclusively on price data. The classic line is, show me the charts, I'll tell you the news.
So trend-following investors, or CTAs, they systematically apply momentum strategies across all global markets.
Yeah, they're exploiting the exact same behavioral biases we talked about in equity quant, but they're applying them to indices, futures, and currencies. They're profiting from that initial underreaction to news investors being anchored to old prices, which is then followed by hurting and delayed overreaction that pushes the price into a durable trend.
And the specific mechanism they use is called time series momentum, or TSMOM.
TSMOM. It's relatively simple in its execution, but it's incredibly powerful. It just involves buying markets that have been rising and shorting markets that have been falling based on their past returns over an intermediate horizon, usually 3 to 12 months.
And the remarkable thing is how universal it is.
It's amazing. It works reliably across every major asset class, commodities, foreign exchange, fixed income, equities, and it has historically provided these impressive crisis-uncorrelated Sharpe ratios.
David Harding, the founder of Winton Capital, he sort of provided the philosophical underpinning for this, right? Viewing it as an agnostic form of investing.
Right. He argues that CTAs don't need to bet on the future scarcity of oil or the long-term outlook for the Fed. They just react to what the market is telling them right now. And his core insight about market efficiency is that most big surprises unfold gradually enough to be captured by trend-following systems.
So why can't prices just instantaneously discount all the information, like the efficient market hypothesis says?
Because information is complex, and processing it takes time. Think about a major policy change or a big geopolitical event. Even if the news is released instantly, the market's collective response is staggered. It's heterogeneous.
Different people react at different speeds.
Exactly. Some participants react immediately, others wait for confirmation, and some are just forced to trade because of portfolio mandates or margin constraints. And that whole process of adjustment is what creates the observable trend, and that provides the window of opportunity for the systematic trend follower to make a profit.
It completely refutes the strong form of efficiency. Instead, you have this gradual trend-creating process that makes the market just inefficient enough to be systematically profitable.
As long as you are disciplined enough to follow the system, the endurance of TSMOM really confirms the persistence of these behavioral biases and the limits to arbitrage.
Okay, that brings us to our final section, which dives into arbitrage itself, the true test of market efficiency. In theory, arbitrage is risk-free profit. But in the reality of sophisticated trading, it's really compensation for providing liquidity and taking on very specific non-fundamental risks.
The practitioner view of arbitrage is basically buying low and selling high across two securities that are almost identical or have some kind of contractual link, and you expect them to converge. But the key distinction is that this is rarely risk-free.
And the profit, the spread, is your compensation.
It's your compensation for absorbing illiquidity risk, funding risk, and sometimes deal risk. The source material calls arbitrage strategies the most direct symptom of efficiently inefficient markets because they exist solely to fix the tiny pricing errors that the market creates.
So let's focus on fixed income arbitrage, or FIA. This relies heavily on these convergence trades.
Right, where two very similar securities are priced differently. And the conviction here is really strong because fixed income securities have a finite maturity. So convergence has to happen eventually. The risk is the timing, not the probability.
And the classic example of this is the trade between on-the-run versus off-the-run treasuries.
Yes. The on-the-run is the newest, most recently issued U.S. Treasury for a given maturity, which makes it extremely liquid for hedging and trading. The off-the-run is an older issue of the same maturity that's just treated less frequently.
So the arbitrager buys the cheaper, less liquid off-the-run treasury and shorts the expensive, highly liquid on-the-run one. They're betting the yield spread will tighten.
Exactly. They are harvesting a liquidity premium. But the danger is liquidity risk itself, especially because this trade is done with massive leverage. The spread is usually only a few basis points.
So what happens during a crisis?
During moments of systemic stress, like the near collapse of LTCM in '98 or the 2008 financial crisis, investors panic and they all rush toward the most liquid assets.
So the spread widens.
The spread widens dramatically. The price of the liquid on-the-run security shoots up while the price of the illiquid off-the-run security falls. And this causes huge losses for the leveraged arbitrager, who is essentially long illiquidity. If they're forced to unwind because of margin calls, they're selling the cheap security into a falling market, which just accelerates their losses.
But those blowouts are also where the biggest future opportunities are created.
That's the irony. It's during those massive dislocations when the spread is at its widest that the potential for future profit is at its maximum, just waiting for patient capital to step in.
Myron Stolz, the Nobel laureate from LTCM, he actually categorized the main FIA trades.
Yeah, he defined 4 main categories. First, curve trades, which exploit yield differences across different maturities. You're betting on the shape of the yield curve. Second, spread trades, comparing bonds to other derivatives, like interest rate swaps.
Or different countries' bonds.
Right, trading Italian versus German debt, for example. Third are convexity trades, which involve trading the embedded option-like features in bonds. That's really important for mortgage-backed securities, where homeowners have the option to prepay.
And the last one, basis trades, brings us back to pure arbitrage.
Yes, basis trades. These are the most direct convergence trades, where you're trading identical or near identical securities at different prices. Scholes noted that most of the fixed income arb business is ultimately a negative feedback business. You're constantly getting paid to step in, provide liquidity, and trade against these short-term, inefficient price moves.
Okay, moving to another really specialized area, convertible bond arbitrage, or CBA.
A very complex instrument.
It is. A convertible bond is a straight debt obligation, but it's bundled with an embedded call option on the issuer's stock. It's debt and equity all in one.
And the arbitrage trade is really ingenious. The fund buys the convertible bond and then simultaneously hedges out the embedded equity risk by shorting the underlying stock.
So what are they trying to profit from?
2 things. The bond component, the yield, and also the option component being cheap relative to its mathematically fair value. The convertible's value is nonlinear, so it has convexity.
And this brings us back to the theme of liquidity. The trade is typically long the convertible because, historically, they've traded at a persistent discount. So why does that premium even exist?
It's a classic supply and demand for liquidity problem, and it's tied directly to funding. Convertible bonds are often issued by companies that need to raise cash quickly. And who buys them? A pretty limited universe of highly leveraged arbitrage hedge funds.
I see where this is going.
So when those funds face redemption requests from their investors, or, and this is critical, when their financing gets pulled by their prime brokers in a systemic funding liquidity event, they are all forced to sell their holdings at the same time.
And since the pool of buyers is small, the price just collapses.
The convertibles become very cheap and highly illiquid during periods of stress, and that creates the persistent compensation premium for arbitrageurs who are willing to absorb that risk.
It's another one of these self-feeding cycles of inefficiency.
It is. The cheapness attracts the leveraged funds, but the leverage of those funds makes the underlying asset itself prone to a massive price collapse when funding dries up.
It's a specialized corner of the market, and it's famously where Ken Griffin, the founder of Citadel, got his start.
He started trading convertible bonds out of his Harvard dorm room. He understood early on that if you could master this niche relative value trade and, crucially, secure the funding, you could generate huge rewards.
Okay, last category, event-driven investments. These strategies focus on capturing profits around specific announced corporate actions.
Right, everything from mergers to restructurings to bankruptcies. The most public-facing strategy here is merger arbitrage or risk arbitrage.
So in a merger, the target stock price jumps up close to the offer price, but it trades at a small discount. That's the deal spread.
And the merger arbitrager buys the target stock at that discount. If it's a stock-for-stock deal, they'll often short the acquirer's stock to lock in the relative exchange ratio.
And the profit they're trying to earn is that spread. So what risk are they being paid for?
They're being compensated for the risk of deal failure. A deal can fall apart for all sorts of reasons. Regulatory intervention, shareholder rejection, financing falling through. This happens about 10% of the time.
So the arbitrager is basically providing liquidity.
An essential service. They let shareholders who want to get out immediately and avoid that residual risk sell their stock. The ARB earns the spread for taking on that specific event risk.
But the market must price that risk. A wider spread means a riskier deal, right?
Absolutely. The market is very efficient at pricing this risk. Deals with big spreads have big risks. Arbitrage managers have to meticulously analyze the predictors of failure. Hostile deals, deals that depend on financing like LBOs, or small deals with poorly rated acquirers, they're all more likely to fail, and so they carry a wider spread.
And they have to diversify.
Heavily. They often limit their exposure to any one deal to less than 5% of their capital because a single deal failure can wipe out months of those small, hard-won spreads.
And beyond mergers, there are also opportunities in corporate restructurings, like spin-offs.
Yes. These events create these technical, temporary demand imbalances. When a company spins off a subsidiary, the parent company's shareholders automatically get shares in the new, smaller company.
But they might not want them.
They might not be allowed to hold them. Many index funds or institutional investors have mandates that prevent them from holding a new, smaller, often less liquid security that's outside their benchmark.
So they just dump the stock immediately.
Exactly. This forced, immediate selling pressure creates a temporary supply-demand imbalance, and it pushes the spun-off securities price below its fundamental value. The event-driven manager steps in, buys that discounted security, and just waits for the initial technical selling pressure to go away. They profit as the price eventually converges back up to its true valuation.
And finally, we get to the gold standard of event-driven trading. A position that really encapsulated all of these principles: conviction, asymmetry, holding power. John A. Paulson's greatest trade ever.
Yes, his bet against the subprime mortgage market in 2007.
It was a masterclass not just in analysis, but in position sizing and psychological strength. He really internalized that George Soros man's axe: when you find a great investment with a clear asymmetric payoff.
You have to go for the jugular. You have to size it aggressively enough for the success to really matter.
So what made the subprime short so incredibly asymmetric? Why was it the greatest trade ever in terms of its risk-return profile?
Paulson focused on shorting the BBB-rated tranches of subprime mortgage securities using credit default swaps. These were the tranches that were first in line to absorb losses after the lower unrated equity tranches got wiped out.
And how were they priced at the time?
That was the key. They were trading at only 1 percentage point more in yield than safe U.S. Treasuries, even as the housing market was clearly deteriorating. So the cost to put on the short position was minimal, about 1% of the notional value per year. But if the underlying collateral failed, Paulson predicted those BBB tranches would be wiped out entirely.
So a 100% gain.
A theoretical 100% gain on the capital you deployed. That is the definition of an asymmetric trade. A 1% cost for a potential 100% payoff. A 100-to-1 risk-return trade-off.
And that asymmetry gave him the conviction to size the position dramatically.
He shorted an estimated $25 billion worth of these securities. But what really differentiated his success from others who also saw the problem was his holding power and his discipline.
Because the market lagged his view for months.
For months. As the crisis started to unfold, the initial losses were massive. Many other funds who had predicted the crash sold when the securities fell to, say, 50 cents on the dollar, and they took a hefty profit. But Paulson refused.
He knew they were worth zero.
He knew, based on his deep analysis of default and foreclosure data, that the underlying collateral was toast. He recognized that the market was still anchored to this misconception of housing safety, and all he needed was patience until those securities went all the way to zero.
He had the financial and the psychological capital to watch prices move away from his fundamental view, knowing that eventually reality would have to catch up. That is the true definition of a strong hand.
It is, and what we've systematically seen across all these different strategies, from discretionary equity to complex macro and convergence arbitrage, is that these investment opportunities are created by market frictions, behavioral biases, and very strict limits to arbitrage. The efficiently inefficient framework just confirms that if you can endure illiquidity risk or funding risk or the immense psychological pressure of a crisis, you are often compensated, and handsomely, for providing that stability and capital when the market needs it most.
So what does this all mean for you, the investor? The ability of a trader or a fund to succeed is often less about some inherent genius and more about the discipline and the capital strength to hold a position when prices are moving away from fundamentals. We saw this in the 2007 quant event, where the leveraged, forced seller suffered the largest loss. That is the strongest weak hand, the one that's analytically correct but is forced to sell at the bottom because their funding or their margin constraints were hit. They had to sacrifice their conviction to liquidity demands. The question for you, the individual investor, is always about discipline and time horizon. Which camp do you fall into? The weak hand or the strong hand with the leverage and discipline to hold the line until value is recognized?
The enduring profitability of all these sophisticated strategies proves that deviations from fundamental value are real and they are exploitable. But they are consistently bounded by the capital and the time horizons of the active investors who are seeking to eliminate them, and that ensures that the market remains in that fascinating state of being efficiently inefficient.
And with that, thank you for watching. Please like, share, subscribe, follow up in next video where we continue our deep dive into the forces that shape global markets.